Ever watched someone make life-changing wealth in crypto only to lose it all the next month? Or maybe you've stayed on the sidelines, afraid of the crypto roller coaster altogether. What if I told you there's a middle path, one followed by the smartest money in crypto? A path that combines the explosive growth potential of digital assets with time-tested investment principles? Today, I'm revealing the true secret to successful crypto portfolio diversification. And stick around until the end, because I'll share the one diversification strategy most crypto gurus never tell you about. A strategy that could be the difference between losing everything and building sustainable wealth. When Warren Buffett says diversification is protection against ignorance, he's talking about traditional markets. But in crypto, even the experts are partly ignorant. We're dealing with an entirely new asset class that's evolving at lightning speed. Bitcoin has surged over 700 times in value over the past decade, outpacing every traditional asset class in history. Yet the crypto market remains wildly volatile, with 30% swings happening overnight. In crypto, under-diversification is dangerously risky, but over-diversification can be equally devastating. Let me explain why. That all-in Bitcoin maximalist might look like a genius during bull markets, but what happens when we enter crypto winter? Meanwhile, the investor who sprinkles tiny amounts across 50 different altcoins might catch a few winners, but their overall returns get diluted by dozens of failed projects. The secret lies in strategic diversification, not just spreading your investments, but structuring them according to principles that have worked across centuries of market cycles. The most successful crypto portfolios are built on three foundational pillars, directly adapted from Benjamin Graham's The Intelligent Investor, principles that made Warren Buffett a billionaire, now updated for the digital asset age. Pillar number 1, the margin of safety principle. In crypto, your margin of safety comes from allocating a significant portion of your portfolio, many experts suggest 40 to 60%, to established cryptocurrencies like Bitcoin and Ethereum. These aren't just the largest by market cap, they have the strongest network effects, institutional adoption, and survivability through multiple market cycles. Think of these as your crypto blue chips. They won't deliver 100x returns anymore, but they're your portfolio's backbone. Pillar number 2, the asset class diversification principle. Beyond just holding different coins, true diversification means exposure to fundamentally different crypto sectors, store of value assets, Bitcoin, smart contract platforms, Ethereum, Solana, DeFi protocols, NFT ecosystems, Web3 infrastructure stablecoins for capital preservation. Each of these sectors responds differently to market forces. When NFTs are struggling, DeFi might be flourishing. When Layer 1 blockchains face competition, infrastructure tokens could be rallying. Pillar number 3, the psychological discipline principle. This is where Mark Douglas's trading in the zone becomes essential. Crypto markets are psychological battlefields, and without proper discipline, even perfect portfolio construction will fail. Studies show that the average crypto investor underperforms the market by 30%, due to emotional trading, buying high in euphoria and selling low in panic. Your diversification strategy must account for human psychology. This means setting predefined allocation percentages, rebalancing on a schedule, not based on emotions, using dollar-cost averaging to remove timing pressure, implementing stop losses, and take profit levels in advance. Let me show you 3 battle-tested portfolio models that incorporate these principles. The conservative model, 60% in Bitcoin, Ethereum, 20% in established altcoins, 20% in stablecoins for opportunity funds. The balanced model, 40% in Bitcoin, Ethereum, 30% in sector-diversified altcoins, DeFi, NFT, Web3, 20% in stablecoins, 10% in high-potential, researched moonshots. The growth model, 30% in Bitcoin, Ethereum, 40% in sector-leading altcoins, 15% in emerging projects, 15% in stablecoins, A diversified portfolio of 7 cryptocurrencies using dollar-cost averaging generated a remarkable 679.53% return over a year during the last bull cycle, outperforming most individual assets while significantly reducing drawdowns. Tools for the modern crypto investor. The infrastructure for crypto portfolio management has evolved dramatically. Today's investors have access to portfolio trackers like CoinStats and Delta that monitor performance across exchanges, helping you consolidate all your crypto investments in one place for easy tracking. Risk assessment tools that analyze correlation between assets and help you make data-driven decisions. Automated rebalancing platforms that help maintain your target allocations without manual intervention. AI-powered market analysis tools that identify sector rotations early, giving you an edge in fast-moving markets. These tools help eliminate emotional decision-making, the #1 killer of crypto portfolios. Remember, in volatile markets, your strategy is only as good as your ability to stick to it. Here's the promised secret that most influencers won't share. The most successful crypto portfolios aren't 100% crypto. The truly sophisticated investors, the ones who've created generational wealth through crypto, maintain what's called a barbell strategy. Aggressive crypto allocation, using the models we discussed. Conservative traditional allocation, stocks, bonds, real estate. Strategic hedges, stablecoins, gold, cash positions. This approach allows you to capture crypto's explosive upside while ensuring that a market crash doesn't wipe out your entire net worth. It's not as exciting as going all in on the latest meme coin, but it's how wealth is actually built and preserved. It's also essential to consider the ever-evolving landscape of cryptocurrency regulation. Countries around the world are introducing and refining their regulatory frameworks, which could impact your portfolio diversification strategy. Keeping up with regulations can help you adjust your portfolio to avoid unnecessary risks, whether through taxation changes or new rules regarding asset ownership. Some sectors like DeFi and NFTs are under the microscope in terms of regulatory compliance. By understanding where regulations are heading, you can safeguard your investments and ensure they remain compliant with the law. And there you have it. The secret to successful crypto portfolio diversification isn't just about which coins you pick. It's about integrating time-tested investment principles with modern crypto strategy. By building your portfolio on the 3 pillars we've discussed and implementing one of our model allocations, you're not just protecting yourself from downside risk, you're positioning for maximum upside when opportunities emerge. Drop a comment with your biggest takeaway from today's video. Until next time, invest wisely and diversify strategically. And don't forget to subscribe to WealthWise Path for more actionable insights and strategies on crypto investing.